IMF is warning that the standoff between China and the US could shave $455 billion off global GDP in 2020. It's the equivalent of South Africa's GDP. Now, globally, that's around about half a percentage point on global output. So we need to talk about this in details. Get out your phones or your devices. CNN.com/join. President Trump is calling for tariffs on Mexico to stop the flow of drugs and migrants on China, and on China to level the economic playing field. So, are the president's policy goals worth the short-term economic pain of tariffs? Cast your vote, CNN.com/join. The recent escalation has become an economists and business leaders rushing to downgrade their forecasts for the US and beyond. At what point does this trade war present a real risk of a recession? CNN's Clare Sebastian investigates.
We've got the hottest economy anywhere in the world.
There's a chill wind threatening President Trump's hot economy, his own trade policies.
Dropping a tariff bomb on Mexico.
From 5% to 10% to 15% to 20% and then to 25%.
China will slap more tariffs on goods made here in the United States. Folks, this is what a trade war looks like.
In the past few weeks, we've gone from a relatively sunny outlook.
The prospect of a potential deal with China and hopes for Congress to ratify the new NAFTA.
To the prospect of a trade war on two fronts. So while most economists agree the US economy is relatively strong, forecasts are starting to darken.
Morgan Stanley says if no deal is reached with China, there could be a global recession in less than a year. Gregory Dacre led another recent survey of US business leaders. They forecast a 60% chance of a recession in 2020.
If we have tariffs applied on all imports from China, which includes a lot of consumer goods, then you would start to see much larger effects on the U.S. economy. You could think of a loss of about 5/10 in terms of GDP growth.
Economists say once the tariffs trickle down to the consumer, the risks multiply. Consumer spending is about 2/3 of U.S. GDP.
When you get into the 25% category, if you're a U.S. importer, there's no way to ameliorate that type of effect through administrative effects or structural changes to your supply chain. You're going to have to pass those prices on to consumers.
An actual escalation in tariffs isn't the only reason to forecast gloom. There's another cloud on the horizon here: uncertainty itself.
That's the biggest fear, I think, right now for the U.S. economy, is that we talk ourselves into a recession.
Fear has already caused stock market volatility, and that could get worse. In another gloomy forecast, Bank of America just cut its outlook for corporate earnings by 1.2% because of renewed trade tensions.
If businesses are pulling back on investment, deciding to delay investment plans, then that in itself leads to reduced activity and in turn leads to reduced GDP growth.
Now, the big picture here is that last year, when President Trump started imposing tariffs, this was a much brighter economic climate. Now, global growth is slowing, the effect of his tax cuts are waning, and if you add a trade war into this wintry mix, well, it may be too late to avoid getting wet.
Clare Sebastian, CNN, New York.
He's with me, former chief economist of JP Morgan Chase. Good to see you, as always.
Good to see you.
This is a very strange economic environment that we're in. The Fed raises rates, everything takes a tumble under worry, and now the talk is lowering rates, and I'm not sure I fully understand what changed.
Well, what changed here is that there is greater risk that the economy can actually slow down. And the Federal Reserve, the European Central Bank, the Bank of Japan, they're all going to take a more defensive posture in order to try to neutralize the negative effects.
But what predicated that slowdown when growth is reasonably good, unemployment is low, inflation is low, and monetary policy is still remarkably accommodative?
Well, Richard, what we have here is monetary policy is always impacts the economy with long and variable lag. So what the Federal Reserve does this week, next month, or next year influences the economy 18 months into the future. So that if we expect some sort of a bump along the road in 2020, the Federal Reserve has to be prepared to act.
Is the trade war driving the slowdown at the moment?
Well, at this point, we are already starting to see business confidence taking a little bit of a hit. We're also starting to see global capital expenditures, including domestic capital expenditures slowing down, and that usually signals what's likely to happen in the future. Because remember that when you have slower capital expenditures, you hire less workers. You hire less workers, you get slower consumer spending.
I'm trying to understand what the catalyst for all of this has been. What started this slowdown?
Everybody knows that one of the big drivers of global economic growth is global trade. When you have trade tensions, guess what? You slow down global trade. Market participants assume that automatically means slower global economic growth at some point in the future. The IMF and the World Bank are also in agreement with that.
OK, so I'm choosing my words carefully so that it doesn't become a sort of a political statement per se, but then the US president's policy of these trade skirmishes, wars, whatever, with China, with Europe, with Canada and Mexico, is having a downward effect.
Well, keep in mind that tariffs, for most economists, is something you don't want to do. But to the extent that you use tariffs as a negotiating tactic, if you succeed, then the threat of tariffs was actually a good strategy. If you don't succeed in the negotiations and you end up with tariffs and no agreement, at that point, it's not a successful strategy.
We don't necessarily want to touch about the sort of the minutiae of the day-to-day gyrations of the market, but a market that fell very sharply in May, 6-7% on the back of worries, rallied yesterday 1 or 2%, now is up again. What message is the market telling us?
The message is telling you that the trade tensions are a negative, but every time they get some signals that we are going to make some progress, either with the Chinese trade negotiations or the Mexican trade negotiations, the market rallies. And the market is also telling you that if the Federal Reserve comes to the rescue, if we have some of these negative headwinds, then the market is also okay with that.
Where do you stand? Time to come off the fence. Where do you stand on an inverted yield curve as a prognosticator of a recession? Do you think this is what we're seeing now?
I think that the yield curve is something you cannot ignore, but there are different yield curves, Richard. There is that 10-year to the Fed funds rate, that's inverted. There's a 10-year to the 3-month, that's inverted. The research that I've done focuses on the 10-year to the 2-year, and that hasn't inverted. I actually developed some research that finds that whenever you get an inversion of that 10-year to 2-year, which we don't have today, and you get the index of leading economic indicators dropping for 3 consecutive months, with a 100% track record as far back as you go into the data, it signals a recession. And guess what? Today, both of them are not giving you a recession signal.
Hang on. What 2 signs am I looking for? The LEIs have to be negative for 3 months.
3 consecutive months.
3 months.
And you need...
Have we had any months?
No, well, right now, in the month of May, we have some indicators suggesting, because they look at the 10-year to the Fed funds rate, and, of course, the orders index is slowing down. So you might get a softer number in May, but we have not had 3 consecutive ones. And guess what? That 10-year to the 2-year has not inverted. You need both of those signals to tell you a recession is coming. And then, on average, 11 months later, you get a recession. I'm
going to watch this closely.
Please watch it.
Yeah, I will. But forgive me, I won't shake your hand with this one, because, unfortunately, I seem to have... my pen seems to have leaked at the prospect of all these inversions. Good to see you, sir.
Good to see you.